The price of Brent crude oil has its lowest levels, or seen its lowest levels, in the last 4 years. Christopher Johnson, Energy Community Editor for Thomson Reuters, joins us now for his analysis of this price all the way from London. Christopher, good to speak to you as always. $77 a barrel is what I have on my screen, and many people came out with a lot of nervousness and harsh reaction to Goldman Sachs' newsletter a few weeks ago when they anticipated that the price would dip below 8. So I take it that's 1 for Goldman Sachs and 0 for the rest of us.
Well, I'm sure Goldman Sachs would like us to believe that. In fact, Goldman Sachs were fairly late to the party on that. They were for quite a long time one of the more bullish houses out there. You know, as in any sort of price forecasting, it's a pretty hazardous affair. At the moment, I mean, we've seen today oil prices plumb below 77. I think Brent crude oil got down to a low of 76. That's the lowest we've seen since, I think it's the 23rd of September 2010, an awfully long time ago when the world was still recovering from the financial crisis. And it just shows the scale of the oversupply in the oil market at the moment. And that was reflected, in fact, in a report by the IEA today.
Is the oversupply the only key concern that's actually driving this price downwards?
Well, of course, when we talk about oversupply, we're talking about a balance which includes both ends of the equation. It's not just we've got too much oil, there's plenty more oil coming out of North America. We've seen an increase of well over 3 million barrels per day in very high quality oil over the last 4 years out of the United States. But also we've got new supplies coming on from South America, and we've got, for example, Asian supplies beginning to come into view, even in China, for example. But at the same time, the other side of the equation, of course, is demand. Now, whereas the boom in very cheap oil in North America is producing a bit of a renaissance in the American economy, Europe, China, and many other emerging economies are still finding growth levels much lower than they were used to, and that means that demand growth for oil is much lower. The IEA today was talking about an increase of between 600 and 700,000 barrels per day in global oil demand growth this year. That's the lowest we've seen since, I think it's 5 years. I mean, they're predicting it will rebound next year, but that depends on economic growth picking up. And at the moment, the signs of that are pretty patchy.
So for the OPEC meeting that's expected to take place later this month, your key concerns that might be on the agenda for them?
Well, OPEC's got to grapple with the oversupply, but the problem for OPEC is that most of the oversupply isn't due to them. In fact, if anything, OPEC supply has been pretty well keeping pace with demand for its own crude. The big increase, of course, has been in North America, and that's something that's not in OPEC's control. Analysts think that if OPEC were to have any significant impact on prices, they would probably have to lop off about 1 or maybe even 1.5 million barrels per day of their own production. That sounds easy for a cartel that's producing well over 30 million barrels per day, but in fact it's not that easy. Demand in the Middle East itself and in OPEC countries has been increasing, and even Saudi Arabia is constrained by what it can do. It produces, it has refineries coming on stream, for example, about 800,000 barrels per day of refineries just coming on stream in the next few months, and that's going to mean a lot of its crude's got to go into those refineries. Having spent all the money on building the refineries, it's hardly not going to feed them. That means that the flexibility in terms of supply for OPEC countries, and this goes for all the OPEC countries, is much reduced.
But supplying at these prices can't be sustainable for them, Christopher.
Well, it is sustainable because although the break-even price, that's to say the price that OPEC countries need for their budgets to meet all their spending commitments, are probably in the main, I think, barring about 2 or 3 OPEC countries, are well above where prices are at the moment. Nevertheless, the cost of an incremental new barrel of oil for most OPEC countries is still below where we are at the moment. I mean, you know, people say, well, you know, surely if they're not meeting their budget needs, they should produce less and push up prices. Well, actually, no. If you're not meeting your budget needs, what you need to do, and you're still making money on every barrel, is produce more in the hope that you can recoup some costs there. And that's the problem. There are no easy solutions for OPEC, and when they meet in Vienna in just under 2 weeks' time, I don't think anyone really knows what they're going to do.
Are there potential unforeseen consequences should they pull back on supply?
Oh, gosh, the consequences for oil prices being low are actually rather good for the world economy. If you're an oil producer, it's not so hot. But I mean, if we're going to be looking, for example, at very much lower levels of inflation, stimulus in terms of demand, then that's probably good for the world economy. You know, quite a lot of economists say that a big fall in oil prices can have enormous impacts on global GDP. For example, I think Goldman Sachs was saying, and some of the other economists reckon that a $10 drop in world oil prices can add perhaps 0.2 or 0.3 of a percentage point to world GDP. That's an enormous increase. So good things there. In terms of the downside, certainly if it prices out some of the newer production, for example in North America, if prices keep falling, then that certainly would eventually push up prices. But the IEA again saying today that they think that's some way off still.
Christopher, just to close off with, the African oil producers, the likes of Nigeria and Libya, are they on the losing end?
Well, they're all 3 or 4 of the big producers, that's Angola, Nigeria, Libya and Algeria. They're all producing below their budget needs, most estimates show. And certainly in Nigeria's case, that's critical. It can have a huge impact on the value of the currency and on the balance of payments in Nigeria. And that's something that that economy is going to have to grapple with. But in fact, if you look at the budget target for the Nigerian government, I think they're budgeting for somewhere around $78 a barrel for oil. So they're being realistic, but certainly if prices stay low for very long, then all of the big oil producers are going to have budget problems. There's no doubt about that.